Today, I'm joined by Mark Sykes, M&A Director at Hornblower Business Brokers, and we're looking at the part of the sale process that often catches business owners off guard: deal structure. When people hear valuation, they naturally assume that's what they'll receive on completion. But in reality, very few deals are paid up front, and how a deal is structured can have a major impact on what you ultimately take away. We're going to explore why deals are structured the way they are, how deferred payments come into play, and how to think about balancing risk and reward. Thank you very much for joining today, Mark.
Very good to be here, Guy. Thanks for inviting us in.
No worries. Well, Mark, we'll start with this. When people hear valuation, they often assume that's what gets paid on day one. How is this different in reality?
It's actually very different. We would estimate that probably 1 in 10 of any deals that are done actually get fully paid out on completion, certainly at SME level. Most deals do involve some type of deferred consideration. So basically, the seller gets a certain amount of money up front on the completion of the deal, and then a chunk of deferred consideration, which could be deferred over 1 to 4 years, maybe even longer, depending on how hard the buyer tries to negotiate. But yeah, that's commonplace at SME levels. And it's typically as a result initially of the buyer's perception of risk, his confidence in in what he sees in the business, and also inevitably the funding sources that he intends to use. For the seller, right from the outset, that really involves, I suppose, a shift in mindset, because they need to stop focusing on the number, the value that's being offered by the buyer, and shift that mindset to what will I actually receive, when, and under what conditions, because there typically are some conditions, or can be, when it comes to deferred consideration. So yeah, very, very commonplace. Any seller that comes to the table expecting to get full value for his business and all paid out on completion quickly has to understand that that's quite a rarity.
Okay, and you kind of touched on it there, but following on, what typically drives the need to structure a deal rather than paying everything up front?
Yeah, the all-important question, and there are a range of reasons, and I'd like to differentiate, I suppose, at this stage between, if you like, the right and wrong reasons for deal structure. We'll start with the wrong ones, and that is that and this is where your advisors come in, and their perception of the type of acquirer that they're talking to on your behalf, on the seller's behalf. If they perceive that the buyer is primarily driving a structured deal because, to put it bluntly, he hasn't got any of his own funding, or if he has, he doesn't want to commit that funding into the deal, then that's the first point to be wary of. Unfortunately, there are buyers out there, and let's be honest, even very good buyers will typically involve some borrowing. They'll go to the market for some lending. There are very, very few buyers who want to commit all of their company's money or all of their funds into an acquisition. So people do borrow money for acquisitions. That's the reality. But the critical thing is that if a buyer has no personal risk, then really that shifts all the risk to the seller. And that's, as I say, where advisors come in to make an assessment of the motives for why structure is being referred to and proposed by the buyer. And if it's just all about not being able to or not being prepared to put in any of their own funding, that's a real red flag. So moving on to the better reasons for deferred consideration, because there are some very legitimate reasons why a buyer will look to defer some of the consideration. And it quite often surprises me that business owners, when they come to preparing for a sale, don't have a better appreciation of this. What buyers are looking for when acquiring a business, first of all, they'll look at the current financial performance and the recent financial performance. But looking beyond that, which they do immediately, what they're looking at is what the business will do in the future and what the risk around the sustainability, which is a very key word in M&A, what the risks are to the sustainability of that performance continuing. And the more uncertainty there is, or perceived uncertainty there is from the buyer, the more structure you tend to see and deal. So what they'll look at is how sustainable is the revenue? Is it contracted revenue? What's the recent growth pattern? So there's a number of fairly basic but very key factors that any buyer will observe. Is there a strong element of repeat business? Are customers coming back time and time again? How large is the customer base? It's a real red flag to any buyer. If the customer base is quite small, they'll then look at concentration of revenue across customers. So the more ideal scenario, and I'm going to use some generalizations here, is large customer base, low revenue concentration per customer. And that gives a buyer a lot of comfort in taking a business on, because if something goes wrong with one or two customers in a larger customer base, it really doesn't matter. There'll be that amount of inevitable churn. So it's things like that. And another key thing is the dependency of the business on the current owner. It's a massive factor. And if a current business owner is working 14, 18 hours a day, and is, the business is very, very dependent on him or her for its success, then again, that's a red flag to a buyer, and he'll want to look at the particular role of the current owner, how that affects the day-to-day customer. Is there a day-to-day customer relationship? So it'll look at all of those things, which all adds up to a buyer's perception of risk. And very, very few businesses, again, certainly at SME level, score 9 or 10 out of 10 in all of these areas. There is usually a legitimate area to perceive that there is some risk. So that's why a buyer will structure a deal to give to decrease that risk in various ways. So those are the better reasons. And another good reason, getting back to the dependency on the current owner, is that it's structuring a deal with some deferred consideration, because in most deals, 99% of deals, there is a required handover from the current owners. The fact that they've got some money left on the table, to put it bluntly, it aligns the interests of the old ownership to the new ownership, and it gives a natural basis for handover, and to ensure that the current owners do support the business through the transition of ownership. So those are the right reasons. Inevitably, I mentioned funding earlier. The amount of money that a buyer can raise inevitably will relate to the deal structure that he eventually puts on the table. And again, that's a very key area for a seller's advisors to really drill into, to look at where the funding sources are, where the money's coming from. Again, what personal equity or company equity will actually be involved from the buyer into that, into the deal, however it's going to be structured. So yeah, all very key things, but those in summary are the right reasons, because if when a buyer looks at a business, there is a small customer base, there is high revenue concentration, there is strong dependency on the current owner. If it's hypothetical, but if a buyer then is expected to put 100% of the money down on the table, then he's taking all the risk. So I described the scenario where the seller's taking all the risk. If the buyer isn't putting any of his own, if he hasn't got any equity risk involved at all. But you can also see that if a buyer was bold enough or foolhardy enough, arguably, to put all the money down on the table, then he's taking all the risks. So the reality is it's somewhere in the middle, and that middle ground is the deal structure, basically.
I understand. That makes a lot of sense. And from your experience, what are the most common types of deferred structures used, and how do they change what a seller actually receives in practice?
Yeah, really breaks down into two types, and there are very many variations, I guess, within these two types, or certainly the second type. The first one is just straightforward deferred consideration. So it's a basic fixed, legally binding obligation for the buyer to pay the deferred consideration, typically in annual instalments, or there might be quarterly payments. That can come in very many ways, but it's a fixed and binding commitment to pay a certain amount at a certain time over of the overall deferred period. So that's fairly straightforward. Less risky, obviously, because then you're only dealing with the risk of the business failing, rather than it having to do a certain level of performance, which is what I'm about to come on to. So straightforward deferred consideration on a fixed structure is the first type of deferred consideration. The next one is potentially more onerous, but not as onerous as some people who don't have the experience might have you believe, and that is an earnout, which is effectively a performance-based element of deal structure. And some deals involve a little bit of both. They'll have the fixed element and then an earnout element. Earnouts can be extremely positive, particularly if there is a mix of fixed and earnout consideration, because typically earnouts should be linked to potentially earning more for the seller if the business performs at X level. So earnouts basically are typically linked to either maintaining the current profit or increasing profit or turnover, actually, because they can be linked to both, or increasing it by an agreed target, and obviously this becomes a sort of hotbed of negotiation. If there is going to be targeted earnouts with an increase in revenue or profit required, then obviously the seller's got to fully buy into whatever those targets are and be comfortable with them. And this again is where good advice is absolutely key, to make sure that targets, that a big price is not sort of touted to get the seller excited, the naive seller excited, but then he's got to grow the business by 20% every 6 months for the next 4 years. That's going to be a problem. So yeah, it is higher risk. It moves the outcome from guaranteed value to conditional value, which is always going to be more challenging for the seller. And the seller, with the right advice, needs to ultimately understand what's fixed, what's contingent, but ultimately has to be confident in, this is where his confidence in his business, which he or she are going to sell going forward, is all important, and their confidence in the buyer, and there's all sorts of elements that go into building that confidence, the experience and background of the buyer, and it becomes much more important if there's an element of earnout consideration. So those are generally the two types of deferred structure.
And you started to touch on it there a little bit, but where do structured deals most often go wrong, particularly when it comes to things like earnouts?
Yeah, great question. And the reality is that, and it still makes me smile after 20 years in M&A, that everybody, either selling a business or thinking about it, or they've heard that their friend is selling a business, everybody seems to have a slightly different version of the same story. And that's, the man down the pub told me that you've got to get all your consideration on day one, because any buyer of any business just makes it their life's worth to screw the seller and make sure that beyond the money that they get on completion, you'll never see anything else money wise, because they won't want to pay you. Those are not the typical reasons that things go wrong, but everybody seems to think that they are if they haven't been through the experience. So it really does, the main reasons for failure of deferred payments does touch on a lot of the things that I've already covered. But in summary, probably the main reason is when a buyer has been badly selected, for want of a better description, and for example, doesn't have experience in the sector, and things can get challenging if a business is for sale and it doesn't unfortunately score very highly in terms of the size of its customer base and the revenue concentration, the dependency, and all of those things that I mentioned earlier. Then ultimately the sad fact is that buyers will not be queuing up to acquire that business, and that unfortunately is where sellers will be more tempted to accept more risk because they have to sell the business. And if that risk involves, and unfortunately, there are buyers out there trying to buy, as many businesses as they can on the best terms possible for them, and building up large groups of businesses, and that's where it's probably the most common area or set of reasons why deals can go wrong when it comes to paying out deferred consideration, and all sorts of reasons can conspire in that sort of scenario. There are so very, very few buyers, even the ones that are trying to build aggressively, groups of businesses only acquiring on their terms. Very seldom do they go into a business purchase transaction with the intent of things going wrong, because why would they do that? But when I think the reality, guys, that when things do falter a little bit or go completely wrong, if a buyer is very experienced in that sector, typically they'll know what to do when adversity comes along, and they'll be focused on solving the problem. Whereas if a buyer, and again I am generalising, but if a buyer is less experienced, less focused, and has another 10 businesses to worry about in his portfolio, and they're all sort of different in different sectors, then they won't know what to do. And even worse than that, they can start moving money around within a group, with their own group, and leaving some businesses short. So it's typically that sort of story. And unfortunately, the world as it is, things can conspire to even the best buyers to make things more difficult and make things more challenging. So so buyer selection, which seems blindingly obvious, doesn't it? But it's really critical. And unfortunately, it's more difficult when a business, isn't highly appealing to the market, when it does have those challenges and those risks that buyers will legitimately try and protect against through a deferred structure. Beyond that, it's so much of this, and I'm not just saying this because I'm an advisor. So much of it is about getting the right advice when it comes to things like deferred, the earn-out structures and the metrics around those, because there are things that are fair and achievable, and there are things that might not be. But unfortunately, you do need the experience to realise that, and business owners coming to a business sale, particularly for the first time, might not understand what's fair and what's not. So that's absolutely critical. And it's so easy, unfortunately, to get a lack of control for the seller to protect them in an earn-out scenario. And this is what we at Hornblower really, I don't know the best way to describe it. Really, we're very focused on this part of transaction management, because it's all important, and there are a whole suite of things that you can build into right from the heads of terms, the first formal agreement of a deal, but also more importantly in the share purchase agreement, which is the formal legally binding contract of sale. There's a suite of things that you can build in to protect sellers in earn-out scenarios, and it's so easy to miss them, and even experienced legal people often do miss them, or at least part of them. So you can build in controls to ensure that the buyer can't just move money around and move money out of the company that is acquired willy-nilly to help another company in the group. You can limit the amount of capital expenditure and operational expenditure, and all of these things are quite difficult to negotiate. But if you don't negotiate them right at the outset, it's where deals can go wrong. So yeah, the definition of controls to support and help the sellers is absolutely critical, and then working with the legal advisor ultimately to make sure those are all reflected in the SPA. Being over optimistic about what the business might do under new ownership, it's quite a common mistake. So getting back to what I was saying earlier, the seller has to be comfortable with any earn-out targets and not sign up to a deal if he's not. And then, as I did mention earlier, unfortunately, bad luck, timing, or circumstances in the world that we're in today, can, God forbid, anybody that bought businesses just pre-COVID or, circumstances like that are obviously going to impact any business. That's a bit of an exaggerated example, but I guess my point is that things can go wrong. But again, from my earlier points in this, in answering your question here, if you've got the right type of control for the sellers and the right things built into the SPA, even when there's problems, the sellers can be more protected. So I guess I'd sum up by saying, Guy, that the earnouts don't fail just because they exist. They fail because they're badly structured or badly aligned, or things are just missed. And if you do get those controls and you get the emphasis in the right places, then they should, and quite often do, give potential upside to the seller if things go well.
Okay, thank you. And finally, Mark, when weighing up an offer, how should a seller think about the trade-off between headline price and certainty of cash?
Yeah, I guess in simple terms, cash at completion is the only ultimate certainty. So, a key part of any negotiation, and the most enjoyable part of our job when we are representing a highly desirable business, which we try and do, is to try and get as much consideration on completion as we can for our clients, for the business sellers. So that is what's going to give you most certainty. I think sellers have to recognise that off the back of that, a lower offer, even if you look at a range of offers, which hopefully you should be in a position to do if you're selling a desirable business with the right representation, then those higher number offers are not necessarily the ones that are going to give you most certainty. So that's when you've got to look at structure. So a lower offer with more cash up front is arguably as good, if not better, as a higher offer that's more structured. Probably fairly obvious, but it's fact. And then going over some previous ground, I suppose it's the need to assess the strength and experience of the buyer, the buyer's commitment, and what they've got at stake and on the table in terms of equity and their own equity into the deal structure. It's looking at what other resources that the buyers have and what they'll have to fall back on, I guess, if times of adversity do come along. And then, if earnout is part of it, it's looking at the achievability of those targets, the level of control post sale, and it's it's looking at all of those things in terms of what you are having to trade off. So yeah, as I said, the best deal isn't always the highest number. It's what you actually realise at the end of it. And in summary, I guess a deal with a high value number but an inexperienced buyer with no specific industry focus, low cash on completion, and a significant amount of structure, particularly if that's purely earn out with stretching targets, is almost certainly not a good deal, just because it starts with a higher number.
Well, thank you very much for your time today, Mark. I really appreciate it, and I'm sure your insight will give a lot of interesting thoughts for our listeners.
You're very welcome. Thanks, Guy.